Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next half hour here on Options Guy TV. So we have an interesting week in that there's a big deal that can happen by the end of this week. There could be a government shutdown. And because of that, we actually have seen another agency, Moody's, come in and downgrade the U.S. debt. So it is starting to become a trend. Obviously, the debt is a big focus recently by just the general economy. So this always seems to happen in cyclical manners where the debt doesn't really matter. Then all of a sudden somebody brings it up again, and then there's a potential government shutdown. So the one thing that is befuddling to me again is that we still see the VIX down around below 15. I'll just make it a general number. It's up a little bit today. We got the S&P 500 index down about 8 points. We have the NASDAQ down about a third of a percent. So we don't really have any activity going on in the marketplace. The Russell 2000 is also down about a third of a percent. And yet this Friday, on the November 17th, at the end of the day, if there is not any headway made by the government, we risk certain parts of the government actually being shut down. So in my mind, I think the VIX should be a little bit higher. There should be a little bit more nervousness, but who knows? Maybe we're making some headway. Maybe the markets don't seem to be as nervous as I am about that potential. So let's hope that we can kick the can down the road, at least have another little leeway before the government will start to shut down. It would be obviously way better if we could just come to terms and actually come up with a budget for the government and move on. That's the one thing the government is supposed to be able to do, is be able to fund programs. So let's hope that it happens. With that said, this show today is going to be more about the retail customer. We have this is retail earnings week. It's that simple. It's going to be kicked off. Well, it's already been kicked off by a couple of companies, but a big one tomorrow is Home Depot. They're going to announce before the open. So I'm going to actually look at a speculative trade in Home Depot. Then after that, we're going to have Walmart. We're going to have Target. So Target is Wednesday before the open. Walmart is Thursday before the open. I think we have TJ Maxx in here. That's also on Wednesday. So we're going to get a lot of insight into what's going on with the retail customer. And let's be honest, the retail consumer is really what has kept us out of the recession. The retail consumer seems to keep spending. We still see wages high. So I guess if you were to say, why is a soft landing feasible in as far as the economy is concerned, it has a lot to do with the retail customer. So I think that is going to start turning a little bit, and we'll see a little bit of slowdown in some of the consumers and their spending patterns. But we're coming into the holiday season. So I think in this earnings season and what's going to happen over this next week is going to be a big driver of how we finish the markets going into the end of the year. So to start with, as we mentioned a lot on Options Guy TV, we're trying to look at the 40 different plays that are inside the Options Playbook and try to find situations in the marketplace where it makes sense to try to use these plays. I'm going to get bearish on Home Depot here. In general, I think I'm a little bit more bullish as we head into the end of the year. We got through September and October. We talked about that last week on Options Guy TV. We started building a portfolio of deep in the money options. It's just a paper trade portfolio inside the TradeHawk software using that paper trade feature, where we're buying deep in the money option contracts in different sectors of the marketplace and selling shorter term calls against them. Well, we might do that this week. I do want to see earnings, though. I don't want to be buying deep in the money call options ahead of an earnings report. One of the things about that is that you're going to be paying for that implied volatility premium. So I like to do it after the fact. So maybe by Friday, depending on how things are going after this week's earnings announcement, might look at trying to add a retailer to our portfolio of deep in the money option contracts. But today, it's going to be all about speculation. And as always, especially in the speculative trades, this isn't meant to be a recommendation. We're just going to look at how we would set up a speculative trade to be bearish on Home Depot ahead of their earnings announcement tomorrow. And if you look at the chart of Home Depot, so let's start by going there. Let's look at the Trade Hawk software, and we're going to pull up the chart on Home Depot. And you can see that it's been volatile. We've had fairly wide ranges of movement in Home Depot, and we've really been struggling right here most recently. So this is the line in the sand. This is a 2-year chart going all the way. So where did we first come down and touch this? It would looks like around 6 in the middle, 616 is when we came down and touched the support line down on the bottom end of the chart. Then we came back again, developed another little area of support right within this range. So a little bit schizophrenic as to where the support should be. But then right here, this was a real scary moment as far as Home Depot stock is concerned, where we did break down below that level of support, right around that 621, but we didn't stay there. So we made another bounce back. We're volatile again, all the way down around the 165 level, all the way up to the 205 level. So the chart's been odd. Definitely, I wouldn't say that this is a bullish chart by any means. We've had a couple of the death crosses, if you will, that have happened in that we had the 20-day cross over the 200-day, and then we had the 50-day cross over the 200-day. So we're definitely down below the 200-day moving average, and I would say that this is, in general, a weak chart. So, and actually, that was all right. All right, let me go back. I think Home Depot is very similar to this. Right. All right. So that was IWM, which is scary similar to Home Depot. Interesting. Okay, so with that said, it's a very similar analysis across the board, but I was looking at the IWM chart. Okay, so interesting to see that to compare Home Depot. I'm a little bit embarrassed by that. To see that Home Depot is very similar to what has happened in IWM. We have this line in the sand. We came down. We didn't touch it there. That was the IWM trade, and we did get long a straddle in the IWM. We're already out of that trade. And now we're hanging right around that 275 level. We have the same type of chart in Home Depot. So this is an area. We had, once again, the death cross where it came in, and we had the 20-day crossing over the 200-day and the 50-day crossing over the 200-day. And just a very similar chart to what has happened in the Russell 2000 index. But this is just an area. It's going to be a very interesting earnings report tomorrow. We're going to, I'm going to assume there might be a little bit more weakness in the stock. And we're just going to get bearish on that. So let's go back to the trading. I totally apologize. Scary how similar those charts are. I'm going to go back and look at the options grid here now. And we're going to focus. It's going to be a very speculative trade like we've done many times around earnings. And actually recently, we've looked at a couple of butterflies on a few stocks. The Magnificent Seven in general, we looked at a lot of butterflies. We looked at some long call spreads. So this is an opportunity to talk about a long put spread or a put debit spread. We are 4 days away. The implied volatility is trading at about 48% implied volatility. And I always want to check, and I look at this just to make sure that I have my dates right, in that I want to see volatility skew. And the implied volatility on the 4-day option contract on the November 17th date, which we actually could get some volatility just because of what's going on in the government. But on the November 17th date, 4 days away, then we go from 48 down to an implied volatility of 32 and then down to 28. So we do see the skewing in volatility. So the marketplace, the options marketplace, thinks that something's going to happen. And we know that tomorrow morning they're supposed to be announcing earnings. So to start with, whenever we're doing a speculative trade around earnings, we look at where the long straddle is trading at. So in this instance, I'm going to, the market right now is at $288.70. So the most at the money option contract is the 287.50 strike. So let's buy this and look at where that expected move is at. So we're going to buy the call and we're going to buy the put. So the expected move at the midpoint here is $12.05. So 1205 divided by 288.71 equals 4%. So that's around normal in Home Depot and a lot of the retailers. Actually, around a 4 or 5% move is expected after the earnings report. Now remember, that's going all the way up to this date because we're using options that have this date. That's the expected move in that time frame. A lot of people will say that that's after earnings, but it really covers the rest of the week. And I kind of like in the Home Depot, the trade that we're going to end up doing is a long put spread. I kind of like that we're doing it on a Tuesday, and you have all day Tuesday, all day Wednesday, all day Thursday, and all day Friday for this trade to play out, especially because of the November 17th date and what could happen in the government and the lead up to that. There's going to be I expect more volatility in the marketplace. I think it's really hard for the market to get bullish if we just don't have a budget in the government. And I think the marketplace has done well so far, obviously, compared to the most recent months, September and October. In November, we've had a fairly good up move in the marketplace, but until we get this resolved, the markets really can't move on. So that's our long straddle. That's our expected move. Inside the TradeHawk software, we highlight a 1 standard deviation move. And that's given us some hint that there is a decent in relative terms, chance that the market could either go down to 272.50 after the earnings announcement or go up above 302.50 or 305. So if we look at the delta, we're talking about a 18% chance based off of the delta, saying this is the probability of that option contract finishing 1 cent in the money by that expiration, is right around 18%. And then the 305 is right around 14%. And it's going to be very similar if we go over to the put side of things. This is where the puts are at. This is the delta on the 272.50 is 1345 and the 275 is 18. So very similar numbers because they're saying this is the probability if the market goes down that it could finish around that level. 16, usually it's about on a 1 standard deviation move, it's going to be about a 16% chance. So we're splitting the difference here. And the strike might not be right on it. And same thing here. Okay, so moral to my story. Why am I talking about the expected move and why am I talking about the 1 standard deviation move? Is I don't want to go all the way down here and buy a spread in this range, or ideally even buy option contracts that are that far out of the money. That to me is pure gambling. We're doing enough of a speculative trade as it is, but these option contracts are trading for very small dollar amounts for a reason. Why? Because the probability, according to the marketplace, of that stock reaching that strike price is very low. So the price is very low. But you can buy a lot of them. You sound like a big player at the cocktail party, right? I own a boatload of these 260 strike put options in Home Depot. I own hundreds of them, but you know what? They're trading for next to nothing, so no big deal. But with that said, that is the concept. So that's why we want to know where the 1 standard deviation move is and where the expected move is. So if we're looking at this and we're at 1287.50 and we're going to call it $12, right? So 287.50 minus 12 is 275.50. 275.50. So we that's where the expected move is at, right within that range. So we would like to sell that option contract, saying that there is a chance, according to the marketplace, that we will actually get to that level. So we're going to do a 5-point wide trade, and let me clear this one out because this is just for our expected move. So we're going to clear this trade out. right here. Let me hit these two little buttons. There we go. And this is the one that we're going to be selling. We're going to be selling that 275.50. There's a decent probability of it getting there just by looking at the delta, about an 18% chance of it getting to that level or finishing at least 1 cent in the money. That means it would be low 275. So that's the option contract we're going to sell. So to set up our trade here in the TradeHawk software, we go to the bid, we go down to this level, we click on that, and it adds a red 1 in our spread column. We'll now go up 5 points. We're going to go about 5 points wide here, and we're going to buy the 280 strike. And so we're going to be buying that one, selling that one. So we're 5 points wide. We're going to pay $1.17 for this. So once again, not that expensive to do. We got $117 plus commission to put this trade on. So the width of the spread is 5 points. So we take 5 minus 117, and that means our upside is going to be $3.83. Or to do it in pure dollar terms, for every 1-by-1 spread that we put on, we have the potential to lose $117 and the potential to make $383. So you're going to have a lower probability of success of making that money, right? But the risk reward is relative. You have lower risk than the potential reward. And usually when you have those scenarios, you're going to have a little bit lower probability of success or making the maximum. And our probability of getting there is about 18% according to the way the market is priced, where the options are priced. That puts us right at that level. Now, we have a 30% chance by looking at the delta. We got about a 28% chance, to be more accurate, of the stock actually going down to 280. So we're paying 117 for that. Now, if you don't like that number, if you think that, I mean, if you think about it as rain chances, the weather person speaking, saying that there's a 28% chance of rain, do you think that's a good probability of rain or a low probability, right? You're putting the math behind it, but it's very possible it could be a sunny day. Very possible that you could get some rain, right around that 30% chance. If you want a little bit higher probability, you're going to have to pay for it. That's simple. So if I want to go back and change that up, I need to go and look at just moving it down a strike, right? So in this instance, this is going to be our official paper trade for the week, and we're going to look at this trade tomorrow or on Wednesday. They'll announce in the morning. We'll see it trade on Thursday, and we'll talk about it on Wednesday when we come back for the next Options Guy TV. But let me clear this out again. So we're going to do that and look at, okay, so if we go down to this strike and this strike, we're still going to keep it 5 points wide. We're going to be selling that one, and we're going to be buying this one. Now we got to pay $1.40 for that. But the probability of success goes from 18% or maximum of getting the maximum down to 22%. Now, that's going all the way out to that expiration date and letting that ride, which is November 17th. And we always want to look over here and make sure that we are in that right expiration. So a little bit more risk, a little bit higher probability, a little bit less of a reward if we get our forecast correct on that trade. So I'm okay with either way that you want to approach it. If you look at this, you got 5 points wide. If you can fill it at the midpoint, which was 140, 5 minus 140, 1 second, 5 minus 140, we're looking at $2.60 on that trade then. So a little bit different risk reward, a little bit higher probability of success. But if I was looking at doing a trade like this on a speculative basis, I don't want to be selling option contracts that are way down below that 1 standard deviation move. They're just, I want something that's within the range. I want it to be feasible. It's going to be a short-term trade in Home Depot. And this is the way that I'm going to approach that trade. Just very simple and straightforward. Now, if you have any questions, feel free to put them inside the chat box. If you are on the YouTube platform, you can ask any questions that you would like. And if I look at this trade and I take it to the next level, let's go on in and just look at the what if scenario. So let me send this to the what if calculator. There it is. Inside the TradeHawk software, here's where the underlying stock is at, 288.23. To start with, we have high implied volatility. So you'll notice that this line, this green line right now, is showing you the profit and loss as of today. But they're going to announce earnings. Implied volatility is going to come in. And as it comes in, the green line will start morphing towards the expiration graph. So to start with, we have high implied volatility. We have a little bit of time value left. But as that expiration approaches, it'll look more and more like the expiration graph. So to start with, we want that crush in implied volatility if we are correct on our forecasts. So tomorrow, after their earnings announcement, if we are incorrect and the market's here and we see it open up this way, we want to get out of the trade if there's something to salvage as quick as possible. But the intention here is if you put this trade on, you got to be willing to risk the entire amount of the trade just because of the speculative nature of it. But if you wait to the end of the day and you get a big move up in the underlying stock, that implied volatility premium is not going to help you at all. It's going to wither away, and we see the green line right here showing our profit and loss. But if you don't act fast on it, and if I saw a gap opening and there was something to salvage, I would sell it and get out. On the downside, if the market does go down and it starts going up, you want time decay to go away. You want implied volatility to come in. And when that happens, then the possibility of making that maximum will actually come into the trade and be much more feasible to be able to do. All right. Well, I don't see any questions inside the chat box. So with that said, that's going to be it for another episode of Options Guy TV. Very interesting week that is going to develop with all these retail sales and all these earnings going into the holiday season. And we'll come back on Wednesday and we'll get a little bit more information. We'll have a few more earnings reports that we will talk about. And if you could please click subscribe, ring the bell so you get all the updates for Options Guy TV. Click that thumbs up. It always helps us out. And we'll see you this Wednesday for the next edition of Options Guy TV. Thanks for coming, everyone.